When putting together a company's retirement plan, consider the delicate balance needed to assemble what's best for the company and its employees to help secure their financial future. You want trusted, independent, objective, unbiased, and expertly crafted guidance that fits together beautifully, along with best-in-class, flexible, responsive retirement services, which is why you may want to speak to us. Newport will pull it all together seamlessly.
Good afternoon. My name is Michael Hahn, and on behalf of all of us at Newport, I'd like to welcome you to today's webinar, Plan Sponsor Liability and Fiduciary Responsibilities in Light of COVID-19. This is a special webinar being brought to you exclusively by our friends at the American Benefits Council, who will moderate a discussion with ERISA experts from the law firm of Jenner and Block. Before we get started, I'd like to go over a few items that can help you make the most of today's event. Lori, if you can move to the next slide, please. You'll see this control panel in the upper right corner of your screen. When you join today's webinar, you chose to listen over the phone or on your computer. If you want to change, you can do so at any time by clicking the audio function in the control panel. We have some materials you can download, including slides from today's presentation, and you'll find that material in the handouts pane. And you can also send us questions at any time by typing into the questions pane of the control panel. Today's webinar is part of a series of webinars we've put together on how coronavirus is impacting retirement plans. Lori, if you can move to the next slide, please. Our next webinar is going to be on April 29th with a focus on plan testing issues and the new normal of coronavirus. And you'll find a link to register for that webinar in the control panel. Next slide, please. Now it's my pleasure to introduce today's speakers. Jan Jacobson is Senior Counsel of Retirement Policy for the American Benefits Council. She provides counsel and assistance on a wide range of regulatory and legislative retirement matters. She staffs the Council's Legal Affairs Committee, which is comprised of in-house ERISA and tax counsel from the organization's member companies, and its Retirement Income Task Force. Jan has extensive experience both as a practicing attorney in the ERISA field, as well as interpreting developments in the public policy arena for clients and others. She's going to be moderating today's discussion with our expert panelists, Chris Rillo and Joe Torres, partners at the law firm of Jenner and Block. Chris is a member of the firm's ERISA practice. He has more than 30 years of experience as a litigator, focusing on ERISA litigation and class action defense. He also has significant experience with benefit issues involving ESOPs, plan fee litigation, retiree health litigation, and other defined benefit plan litigation. Joe is chair of the law firm's ERISA litigation practice and co-chair of its labor and employment practice. He concentrates his practice in labor, employment, and ERISA litigation before state and federal trial and appellate courts, as well as administrative agencies such as the NLRB, the EEOC, the DOL, and OSHA. All in this in a wide variety of discrimination, employee benefit, whistleblower, and other labor and employment claims. As I mentioned earlier, we're really pleased to have the American Benefits Council bring us this information. And without further ado, I want to turn things over to Jan. Jan, take it away.
Thank you, Michael. And hello to all our friends at Newport Group, and welcome to all our listeners. We at the American Benefits Council are happy to bring you this webinar on plan sponsor liability and fiduciary responsibilities in light of COVID-19. We always enjoy working with our friends at Newport Group, and we have a great working relationship. I also want to express our appreciation to our experts on today's webinar, Chris Rillo and Joe Torres. for sharing their expertise in these trying times. Litigation risks are always a concern for employee benefit plans, and the potential liability has only been exacerbated by the COVID-19 pandemic. I hope all of you are continuing to stay safe and healthy. Chris and Joe will start with defined contribution plan issues and then discuss defined benefit plan issues, followed by ESOP concerns, and finally, welfare plan issues. With that, I would like to turn it over to Chris Rillo to begin their presentation. Chris?
Good afternoon. The statistics, the economics, may I have the next slide, please? And the next slide, please. The economic statistics on this slide are already outdated and was written about 7 days ago. There's no question that the economic impact of COVID-19 is immense. It resembles the Great Recession, and the way it looks right now is it may exceed the statistics of the Great Recession. In the United States, it looks like social distancing, it says, is recommended through May 1st. My guess is it's going to be recommended through all of May. It's probably going to be only in June when things might get loosened. Unemployment claims surged, 10 million in the last 2 weeks. More than 6.6 million claims were filed in the last week of March. Again, that statistic has only increased. The St. Louis Fed came out with a study that captured everyone's attention, predicting that the economic freeze forced by the coronavirus will ultimately put 47 million Americans out of work, spiking the unemployment rate to 32%, which exceeds the greatest rate in the Great Depression. In the Great Depression, the rate of unemployment was approximately 25% at its height in 1932. This slide says equity markets have declined, but it's not only equity markets, all asset classes have declined, which causes a lot of the fiduciary issues we're going to see. Not only equity markets have declined, but fixed income instruments have declined. We recently saw in the past 2 days that the spot oil price for futures went negative, meaning you would have to pay $37,000 theoretically if a 90-day contract expired to take delivery of oil. First time that's ever happened. And that gives rise to a real concern that we're entering into an era of deflation, which could be extremely damaging. These unprecedented economic and social conditions raise challenges for plan administrators, fiduciaries, and plan sponsors. One of the biggest challenges is the fact that when plan assets decline, as they will inevitably, you start to see litigation claims arising. May I have the next slide, please? We're going to discuss first defined contribution claims, and we're going to discuss several topics. The first is we expect a return to stock drop litigation. The second is there's some glitches that already occurred with record keeper crashes. Third is we expect 401k plan litigation alleging imprudent menu options and fee issues to arise. The next is we're going to see target date funds, we're going to see stable value funds, bond funds, all under issues, all under pressure because of the decline in their values. Administrative fee issues, as I mentioned above, are going to rise again. We're also going to see strange things such as whether some plans will experience partial terminations because of layoffs. Other administrative issues, including hardship distributions, plan loans, and the CARES Act will be briefly mentioned. And next slide, please. I'll turn it over to my colleague, Joe.
Thank you, Chris. Good afternoon, everyone. So just to sort of set the stage here for people in terms of the risks, you all may be familiar with the standards that plaintiffs have to contend with in stock drop actions, and we wanted to start with just a reminder that under the Dudenhofer case and then more recently under the Harris case, there is a relatively high bar that plaintiffs have to demonstrate in order for them to bring a stock drop action. So that's obviously been a positive development in the law. The standards set forth on the slide, and we're not going to spend a lot of time on that, but it's also important to know that that standard was recently reaffirmed by the Supreme Court in the Janda decision from this year. Next slide, please. And so, at least to start with some good news, under that standard outlined on the prior slide, it is difficult for plaintiffs to allege a viable stock draw complaint. It typically requires, as indicated on the prior slide, that they would have to show some plausible alternative action that would have been consistent with the securities laws. But you have to consider the benefit that high standard brings to plans and plan committees in the context of the current pandemic and effect it's had on the economics of the world. Certainly a plausible claim could still lie where plan fiduciaries are not acting or acting soon enough to consider their options in rapidly changing environments. And then certainly things that are in some respects outside the immediate control of a committee, where securities have simply fallen so drastically that there is just no time to react to some of the actions that may be occurring. So if we see ourselves with continued negative returns in the equity markets over the coming year, if we're seeing, unfortunately, an increase in insolvency, or at least companies under significant financial distress, you do get into this situation where affected participants may still be interested in trying to pursue stock drop actions to recoup their losses, even in the face of the high standard that they otherwise have to allege. And as I'm sure you're all familiar with, these claims become difficult to resolve in part because of the potential liabilities associated with them and the unwillingness of plaintiffs' lawyers to necessarily resolve them sooner rather than later, in the hopes of increasing the leverage on the plan and the plan sponsors to reach a higher settlement than might otherwise be appropriate. Next slide, please. And so while those are certainly things to be concerned about, there are some steps that the committees can be taking today, things they can be thinking about to proactively mitigate the risks that I just explained and outlined on the prior slide. These are not new, but certainly this is the type of situation and atmosphere when a renewed attention and documenting your assessment of whether or not there are additional steps that should be taken becomes critical. So committees should be engaging in robust procedural prudence regarding the operations of their plans. They should make sure that that information is well documented so that they're able to demonstrate that they acted prudently in evaluating risk. They should, given the frequency and the rapidity of which events are occurring right now, more frequent meetings of the committees is certainly advisable. And it's also, again, not something that you might not otherwise consider in other contexts, but evaluating and seeking independent investor advice in this context is an additional consideration that committees should take under advisement in demonstrating that they were thoroughly evaluating and assessing the current circumstances and identifying what additional steps may be necessary. Additional considerations may be to consider whether company stock investments should be frozen, whether contributions by participants should in some way be limited, or whether the circumstances are such that liquidating the stock fund is advisable. Again, these are certainly significant steps that are not to be taken lightly, and it's important to stress that these are not cookie cutter solutions. Each plan has to look at its own facts and circumstances to evaluate the appropriate steps forward. But again, if you are considering to continue to maintain company stock assets, as we said before, getting independent advice, outside advice, documenting that advice in this current environment is highly advisable. Now I'm going to turn it back over to Chris to cover our next topic.
Thank you. Can I have the next slide, please? We're going to go into a granular examination of several specific issues that may arise. Could I have the next slide, please? The first issue is target date funds. Target date funds, since their creation in the late 1990s, around the 2000, have become ubiquitous in funds. Over 90% of defined contribution plans have target date funds as according to their assets. And target date funds have one particular problem, which they're likely to underperform other assets as markets decline. And in today's environment where all asset classes are declining, you normally have a situation that if equity markets decline, your fixed income will conversely improve, but everything is declining. These funds will be under pressure and may underperform other assets. At the same time, participants often have an expectation that target date funds are more conservative, which they are because they're hedged, and that they're safer than other investments. Target date funds are sold on the premise, that the original premise was that they're kind of a glide path instrument. If you buy a target date fund, if you're in your 40s, that will have slightly more aggressive investments, but should end up with something, it's not an annuity, but should end up with something that would be good for you to retire on, as the basic premise of the product. Other target date funds that are based on a basket of government and municipal securities, and there are many funds based on that because, again, the conservative nature of these investments, may perform demonstrably worse than other funds. The Treasury bill, short-term Treasury bill, is paying next to nothing, according to the latest auctions in New York. And as I mentioned before, disclosures on target date funds can be extremely problematic. The plaintiffs' bar, in fact, was targeting target date funds before the current economic downturn. They were looking closely at them, and they're bringing steadily a drumbeat of lawsuits, class actions against plan sponsors and plans that have target date funds included. The latest was the Bank of Oklahoma, which has a relatively good plan, was hit with a class action from a Minneapolis law firm about 3 weeks ago. So, fiduciary committees should examine carefully their target date investments, understand the mix of investments that are making up each fund that is being offered, each particular security product, and be especially wary of securities largely predicated on government and municipal bond securities. May I have the next slide, please? Another issue is stable value funds, which are often thought as being extremely safe. It's a place where you park cash and get a slightly better interest rate than the banks. Well, why do you get a slightly better interest rate? Because there's some risk involved. Stable value funds may experience negative returns in this interest rate environment. Again, participants regard them as extremely conservative investments that are used to preserve capital. They're offered because they generally have a superior return over money market funds. However, in the 2008 recession, there were several funds that experienced negative returns. The worst was a 2009 Chrysler stable value fund that wasn't in a qualified plan. It was in a deferred compensation plan that when Chrysler went into bankruptcy and the fund was liquidated, it ended up paying 89 cents on the dollar. State Street funds, several of them went into a negative environment. I was involved in one case involving a State Street fund defending a fiduciary in Boston in the 2008 recession. State Street ultimately had to contribute $610 million to the funds to rescue them. Some of the possible claims and reasons they would go negative are, of course, their fees, which will drag on the return, and the wrap contracts. The wrap contracts are a contract that guarantee the return. They rely on the financial integrity of the issuer. In 2008, when AIG exploded the universe with its insurance product that was a derivative insuring against risk of negative returns on securities, several wrap providers went under. Let's have the next slide, please. So plan committee has to be proactive here. You have to examine several issues with stable value funds. You have to look at the fees, make sure you have competitive fees. You have to look at the investment mix. You have to look at the wrap contracts and the integrity of the issuer. You have to look at performance, of course, and then you better review your plan disclosures to participants. and highlight the fact that there could be a negative return if there's a extremely negative interest rate environment such as we have now. May I have the next slide, please? A related issue is with the next product that we're looking at, which is money market funds. Money market funds, like stable value funds, can experience negative returns. It has already happened in a sense. On March 20th, the Federal Reserve instituted a $500 million facility to support money market mutual funds. That mirrored what the Fed had to do in 2008. Now, these fund disclosures can be even more problematic because they often advertise a stable $1 share price. And participants rely on that to park money in them, believing they're as safe as a bank. Of course, they're FDIC insured. So a fiduciary committee again has to examine fees, disclosures, and performance. There's already been litigation over money market funds. Most of the litigation over the past year has been complaining that plans have used money market funds inappropriately instead of stable value funds. Well, the plaintiffs already have their eye on these classes, these classes of investments. May I have the next slide, please? Similarly, bond funds is the next product. Now, bond funds will underperform in a sustained economic decline, such as a low interest rate, which is accompanied by a low interest rate environment. Participants regard these funds as absolutely safe, and there has been past experience where they've exploded for that reason and caused litigation risks that have been unforeseen. I started my career on the First Pennsylvania case, which was First Pennsylvania was the largest bank in Philadelphia. In 1979, 1980, aggravated by losses in investments, it decided it would pour its capital into T-bills. And what it didn't foresee was that interest rates would climb to 20% as Paul Volcker attempted to get inflation under control. And it was subject to a negative arbitrage that nearly took the bank under. The Fed had to save it. I had another case in the 2008 recession that dealt with a well-established financial institution, one of the top 10 banks in the country, which had a subsidiary that invested in bonds, but the bonds they invested were collateralized mortgage-backed securities, which became illiquid in July 2007 when Fitch issued its opinion stating these things are not marketable. They went from a value of whatever they had to being worthless and absolutely illiquid, meaning they couldn't be traded. We had a class representative who was a proverbial little old lady in tennis shoes, an 83-year-old woman living in Alabama, who was crying in her deposition that the lousy $10,000 she had was invested in the bond fund and it was worthless. Fiduciary committee should examine, again, fees, disclosures, performance, and also the makeup of these funds to try and understand what they're based on and that they're appropriately diversified. May I have the next slide, please? Administrative fees are always an issue, and they are an issue in small and large plans. You should examine, be aware of them, and consider your alternatives, including doing a 316 arrangement with an appropriate TPA or appropriate service provider. But it's something you should be aware of. And with that, I'll turn it. Can we have the next slide, please?
Thank you, Chris. Turning to partial terminations, as you all may know, in environments such as these where employers may have to lay off or furlough individuals, those events can occur suddenly. There can be a lack of understanding as to whether the layoffs are temporary or if they are temporary for how long, or whether some of these may actually become permanent, depending upon the forthcoming economic cycles. So committees need to be aware, and plan sponsors, that many plan terms require vesting if a significant percentage of employees are terminated or laid off. Under a revenue ruling from 2007 and some case law, the general guidance is that if the turnover is that occurs is 20% of the covered population, there is a presumption that a partial termination has occurred. And so, depending upon the size of the organization and the impact that a layoff may have on the covered population, plans need to be mindful of the fact that that could cause a vesting event for the individuals who are being terminated and laid off. The actions here are as much beyond simply the awareness of that possibility, is to understand that this is, and it tends to be an issue that is driven by the human resources function of an organization. And so the additional planning point to be mindful of here is to make sure that as HR is evaluating possible furloughs and reductions, that those are being evaluated not only from the economics of the compensation associated with these individuals, but also the potential consequences of a partial termination. And so it is critical that all of the relevant actors from HR, employee benefits, et cetera, are coordinated so that if this is going to occur, it's done with awareness as opposed to being something that you're then having to deal with in the aftermath of a termination or furlough that's already occurred. Next slide, please. So the next, we're now going to turn to defined benefit plans. This slide just lays out the topics we're going to cover regarding funding implications, the impact of low interest rates on potential lump sum payments, cash balance concerns, as well as some plan liability litigation risks that actually are looming but aren't necessarily driven by the pandemic, but nonetheless something that could give rise to some additional litigation risk in this context. Next slide, please. So the first topic we wanted to talk about was single employer funding concerns. As you know, typically those plans are required to be 80% funded to avoid any restrictions that may otherwise arise under the relevant statutory scheme. The CARES Act did give some relief to companies with respect to this funding, allowing that the terminations in 2020 be based on 2019 fundings. So that in turn may also drive issues into next year where lump sums typically are looking to a specific month from a prior year. So this is certainly something that will continue to be an issue that needs to be monitored into the next year. Sponsors need to make sure that they're budgeting necessary plan contributions in order to avoid falling below the funding requirements that we talked about a moment ago. Also, of course, being exacerbated by the rapid drop in the markets, which then obviously make it more difficult for plans to evaluate, have the line of sight to what appropriate steps may have to be taken. There certainly may be additional relief in this area on the legislative front, depending upon the uncertainty that may continue to haunt the markets on a going forward basis. Next slide, please, Chris.
Another issue that comes up is the low interest rates will increase the lump sum payouts because the rate multiplier has fallen, increases the product. And more participants will be seeking lump sum payouts, both because of the CARES Act and just taking distress withdrawals, regardless from their plans. The CARES Act gives generally a 3-year window to repay any withdrawals without tax penalties. And other people will be seeking early retirement options. So plans will face additional lump sum payouts. And that's something to keep in mind along with the funding. Can I have the next slide, please? Other issues that'll come up is because of the low interest rates, it's going to cause some curious anomalies in backloading. Could cause some plans to go to the test rate or even fail a backloading calculation, which raises backloading for the first time since probably the 10 years ago. We worried about backloading with the cash balance conversion cases. The other is the active interest credit rate, which is the rate applied to the hypothetical account balance for purposes of satisfying the backloading rules, will give anomalies. With that, go to the next slide. I'll turn it over to my partner, Joe.
Thanks, Chris. As I mentioned before, there are some additional developments we wanted to make you aware of in this space that aren't necessarily tied to the pandemic, but there is a pending case having to do with whether or not plan participants are allowed to pursue certain claims, even though they may not be entitled to any monetary relief. The case that's on the slide right now sets forth the prior rule, which was that participants may have standing to pursue claims for equitable relief, but not for claims for monetary relief, since typically those, the relief would flow back to the plan itself, and so the risk of underperformance was typically borne by the employer, not by the plan participants. Next slide, please. That rule was brought into question by the Thole litigation that's listed on this slide. There, the district court found that the plan participants did not have an ability to to pursue their claim because the bank and the defendant in question had made voluntary contributions to overfund the plan, thereby eliminating the basis for the lawsuit. They appealed that to the 8th Circuit, which similarly rejected the argument that they continued to have standing simply because the plan was underfunded when they filed suit. This case then went up to the Supreme Court, which heard oral argument on the 13th and raised the question as to whether or not they could have standing to seek conjunctive relief without demonstrating individual financial loss. So that we're waiting for a decision. If that case is resolved in participants' favor, it could increase the amount of claims that you might see, because it would give plaintiffs greater standing to pursue these claims, even if they could not demonstrate an individual financial loss. I'm going to turn it back over to Chris to talk about potential issues in DOL ESOP litigation. Chris?
Next slide, please. ESOP litigation has become remained to be a hot topic. The DOL raises it as one of their primary concerns. It's an enforcement concern that unfortunately doesn't matter which party controls. The Republicans are just as happy right now on the political side of the DOL, just happy to go after ESOPs. And there's a lot of private party litigation. The top 10 issues, it was funny, Tim Hauser, who ran the PBSD at the Department of Labor for years, was asked about ESOPs, but he thought the top 4 issues were, and he just said valuation, 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 which gave where he was thinking about. If you refine it a little bit, these issues seem to appear most in DOL litigation. The first are projections, which are used in valuation. The second is control, both the control premium and adjustments to the valuation because of control. Third is lack of negotiations. The fourth is using inappropriate market comparable to come up with your valuation. For example, using a publicly held company or a company in a different industry. The fourth are warrants and stock appreciation rights, often granted to founders, and they might have a dilutive effect that's not taken into account in the valuation. The next issue is indemnification. The Department of Labor and now private plaintiffs believe that indemnification is absolutely improper by an ESOP company to any fiduciaries or trustees or third-party service providers. Next is customer concentration. If the ESOP's customer base is inappropriately concentrated, among a few customers or inappropriately concentrated in hindsight view among a certain industry, that raises an issue. The next is related to that, which is they look at this, they've litigated over the specific risk premium and the lack thereof in evaluation. Next is prior, and especially if they're lower, stock valuations, letters of intent, indications of interest. They're often taken into account in valuations to support valuations. Sometimes they're not taken into account. And the next is immediate post-transaction drop in value, which often happens simply because the ESOP is leveraged. If you buy a company for $100 million and it's valued at $100 million, if you take a valuation, a snapshot the day after you buy it, the company will look worthless because they'll have $100 million in debt. These transactions are heavily leveraged. It doesn't mean the company's not worth anything, but those valuations come up in litigation, both in private party and the DOL. Go to the next slide, please. Now, one issue that's come up that's particular to the economic environment we're in deals with interim valuations. Given that asset values are diving to the floor, chances are a ESOP-owned company is going to be worth less in this environment than it was 6 months ago. Most modern plans allow for interim asset valuations. And the other thing that's true is that if the ESOP is leveraged, the plan assets are going to be used for debt service, and redemptions are going to come out of the corporate assets, out of the corporate chest, if you will, either transferred to the plan for the plan to make the payment, or sometimes paid directly by the company in certain circumstances. So the issue comes up with whether you should do an interim asset valuation. It's hard to give a hard and fast rule for this. The first rule, of course, is the plan has to permit it, but most plans do permit that. The second is you have to look at your liability risk. If you did the transaction within the past 6 years within the open statute of limitations, and chances are you did it because it's a heavily leveraged plan, you have to consider with your attorney whether or not it's potential, there could be a potential claim made if you do an interim valuation that departs radically from the sale valuation. That's something that you have to look at and figure out. Balanced against that is the fact that doing an interim valuation may reduce the cash drain. And then you also have to look at what's the anticipated redemptions that you're going to be faced. What's the stream of redemptions that you're going to be faced in this environment? It's a difficult issue. It's one that a lot of ESOPs are considering right now. And with that, I'm going to turn it back over to my partner, Joe, for the next slide.
Thanks, Chris. Briefly, we wanted to cover a couple of welfare plan issues that you may have to be thinking about in this current environment. One that's getting we're seeing a lot of questions on having to do with eligibility issues as employers are furloughing employees, understanding whether or not reduced hours is going to affect their eligibility under a welfare plan, the impact that the Affordable Care Act requirements may have on your ability to do that. Obviously requires you to be proactively looking at your eligibility language and the relevant plans to understand what the impact might be on workforce reductions on eligibility, whether or not you're understanding whether people will lose that eligibility, whether you're trying to figure out ways in which they could maintain their eligibility during a reduced workforce environment. The first place, obviously, that you're going to have to start with there is on your plan language, but that is definitely an issue that's going to continue to persist as employers are trying to manage workforces with reduced staffs. Next slide, please. Additional issues that also are coming up having to do with pandemic-related illnesses, where that is requiring coverage, and the question as to whether or not there should be some exception, waivers of co-payments or other benefits to deal specifically with the COVID-19 sicknesses. Some of the insurers are waiving co-payments and providing related to providing such benefits, or requiring that certain benefits be provided, or allowing certain benefits be provided without cost. With that obviously raises some issues with under self-insured plans, for example, with respect to things like the Mental Health Parity Act, which requires non-discrimination amongst how conditions are treated. And so employers, self-insured plans who are thinking about whether or not to grant exceptions need to evaluate whether or not allowing one medical condition to receive preferential treatment could potentially give rise to mental health parity claims. There's already been a fair amount of litigation in that mental health parity space even before COVID-19 came on the scene. So again, it's just something that employers, self-insured plans need to carefully evaluate. And what insurers have elected to do doesn't necessarily provide a roadmap that can be automatically applied in the self-insured space. Chris, next slide.
And then the other issue caused by this pandemic is out-of-network provider issues. There's already a lot of litigation where providers principally are challenging plan payment reductions to out-of-network providers. In the current medical crisis, it's very likely that participants will be serviced by out-of-network providers. It's an issue where you may want to consider what your alternatives are. It's an issue that you're likely to see litigation on if you your plan enforces it, and you may have no choice but to enforce it. Could we have the next slide, please? And with that, we're going to thank you for listening, and we're open to listening to questions.
Thank you, Chris and Joe. That was a great presentation with lots of very useful information. We do have a couple of clarifying questions based on your discussion of defined benefit plans and the stock drop cases. And the clarifying question on the defined benefit plans is, what is an RIF or RIF?
Reduction force. So layoff is probably another sort of analogous term you would use for that.
Right. And then with regard to the stock drop discussion, it's a little bit more detailed question. What does stock drop mean? To play the devil's advocate, is it not already too late to freeze stock, limit contributions, et cetera, when the stock has already dropped?
Sure. So good question. So stock drop cases, that is a descriptor used to describe litigation where the participants are arguing that the decline in value of stock was somehow could have been alleviated if the fiduciary, if the committee took some affirmative steps to limit investments in that fund, prohibit investments in that funds, et cetera. So it's the routine reduction in the stock drop, if you will, that is it gave rise to the name. In terms of the devil's advocate question, typically, as I said, the fact pattern in stock drop is that the fiduciary was aware of something that may happen in the future, and they, for whatever reason, declined to take action to limit the potential losses that might arise out of that potential development. So the fact that, as stocks have already dropped significantly does not mean that there isn't a risk that, with awareness of future developments, fiduciary committees could be at risk for additional reductions in stock that may occur, especially when you're seeing stocks rise and drop so precipitously. So the point about limiting investments or contributions really goes to it is still a viable alt strategy, because as your stock stabilizes at point A, and then arguably you become aware of some other potential development that might cause stress to the stock, the question is whether you can demonstrate that you were evaluating the upcoming circumstances as best you reasonably could as a fiduciary, in order to potentially limit additional drops and reduction in the stock that might occur in the future. Does that help?
There's one clarifying point, which is, I think, from the question. It deals with company stock from the issuer, the plan sponsor. In other words, IBM will put their own stock in the plan as an investment option. So it's a situation where it's a publicly held company and you put stock into the plan.
Thanks, Chris. Yeah.
Yes, I think that's very helpful from both of you. Thank you. Another question is, employees leaving employment, whether because of a layoff or moving to another job, may be pushing for immediate distributions. This may be difficult for companies that have closed down. Is there a deadline for making the distribution after paperwork is completed or an online request is processed? And does that vary based on plan language?
Well, there's no deadline in ERISA except that you have to follow plan documents. And plan documents often do state that the distribution will be reasonably processed. And if you delay unreasonably on it, you may get a call from a Department of Labor investigator in San Francisco or Chicago asking why is the participants complain. It's one thing that participants will do is complain to the Department of Labor fairly quickly, and the Department of Labor takes these complaints fairly seriously and acts quickly on them. So the issue is with plan language. Now, this is a perfect segue to making sure you have a good TPA, making sure you have a good plan administrator helping you if you're a smaller company with your plan. But in terms of ERISA deadlines, it's just following plan documents. I'm unaware of any specific ERISA or IRS regulatory advice on that, other than it should be expeditiously handled in accordance with the plan. Excuse me.
Thank you, Chris. And one more question that probably everybody's wondering: are we expecting additional benefits related COVID-19 guidance from the federal agencies like IRS, Treasury, and Department of Labor, maybe the PBGC?
Well, Jan, you're in DC, and I am certain, as my name is Chris Rillo, that they have young lawyers at both the service, the IRS, and the Department of Labor, as well as probably 20 other agencies in the United States Capitol, given that we're spreading trillions of dollars into the economy, that are probably writing regulatory advice, not only regulations, but also some field bulletins and other regulatory advice. I've seen that but I know for a fact that we'll have a panoply of regulatory advice to give us some sort of comfort, some sort of guidance in getting through this unprecedented era that we're in.
Oh, I definitely agree with that, Chris. I think they've issued some guidance and some deadline extensions, and we know that they are working hard to provide additional assistance. A lot of guidance has been issued on what's been called the Stimulus 2 bill. That was the bill before the CARES Act that had a leave and paycheck protection program, that sort of thing. And at least based on that guidance, we might see guidance in the benefits area on the CARES Act in the form of frequently asked questions. Regulatory projects, of course, taking a longer period of time, and there's an urgent need for the guidance now. We've been regularly talking with folks from all of the agencies involved, so we do know they are working hard. They have established teams to address particular questions, so hopefully they're able to get this guidance that we need out on a timely basis. So I think with that, I'm going to turn it back over to Michael for closing the webinar. Michael?
Jan, thank you very much. And a big thank you also to Chris and Joe. This was all great information. And again, thanks to all of you for attending today. Lori, if you could advance it to the next slide for me, please. Before we sign off today, there's some important information for you. You can download today's presentation and a handout. There's some additional information. You can access all of that from the control panel. We'll also send you an email in the days ahead with more of that information so you can access it there as well. Lastly, many of you sent us questions regarding plan compliance concerns in light of COVID-19, and we encourage you to register and join us next Wednesday for our next webinar. It's entitled Navigating the New Normal, Anticipating Plan Compliance Challenges in the Age of Coronavirus. So we hope to see you there. And again, thank you so much for attending. Have a great afternoon.
Thank you.